This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 354 was produced on December 15th, 2022. I'm Eric Townsend. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Bianco research founder Jim Bianco returns as this week's feature interview guest. We'll get Jim's take on the major events of the last 72 hours that everyone's been focused on, the CPI data and the Federal Reserve statement and press briefing. Then we'll get Jim's insights on news most people missed, China's announcements that they'll stop reporting COVID case counts and effectively just let the Omicron virus burn through while relaxing zero COVID policies. We'll also discuss Jim's outlook for fixed income, equities, gold, and more. This will be our last regular format podcast for 2022. For the final 2 weeks of the year, we'll be airing our pre-recorded 2022 year-end special. This year, the subject will be all things nuclear energy. My guest next week will be Mark Nelson, a nuclear engineer and pro-nuclear policy activist. Mark and I will discuss understanding all things nuclear, from both real and perceived problems with nuclear energy to understanding advancements in nuclear energy, including the benefits of advanced nuclear reactor design such as heavy water reactors, molten salt cooled reactors, and liquid fueled reactors. Then the following week, on December 29th, my guest will be Uranium Insider newsletter editor Justin Hume, and the topic will shift from understanding all things nuclear to investing in all things nuclear. Justin and I will dive into the nuclear fuel cycle in detail and discuss how investors can position themselves to profit from the coming uranium bull market. Then we'll move on to investing in small modular reactor technology and advanced nuclear technology such as molten salt. Listener feedback from past year's year-end specials has been that you particularly enjoy longer episodes on the holiday weeks when you have more time available to absorb longer format content. So put your seatbelts on next week when our first nuclear special will run well over 2 hours in length.
And I'm Patrick Ceresna. Listeners, be sure to stay tuned for our post-game segment after Eric's feature interview with Jim Bianco, when Eric, Nick, and I discuss the charts on the S&P 500, NASDAQ, gold, and the oil markets. Now, Eric, before we move on to the feature interview with Jim, let's cover crude oil, starting with the EIA inventory numbers.
EIA inventory printed a massive 10.2 million barrel build on crude oil inventories. Now, that was really only a 5.5 million barrel build after you consider the 4.7 million barrels that was drawn down out of the Strategic Petroleum Reserve. Cushing, Oklahoma, building 426,000 desperately needed barrels. Gasoline building 4.5 million barrels, distillates building 1.4 million barrels. So builds across the board. U.S. production ticking down 100,000 barrels to 12.1 million barrels. I can say now with strongest conviction and total and complete confidence, I'm completely and totally confused by this market and can't make sense of what's driving it. The best I can do this week is to share with you why the tape action makes no sense to me. Starting with inventory and the market's reaction to it, builds are normally bearish. This week we have an epic build of more than 10 million barrels, a long overdue Cushing build, and gigantic product builds. Net them together and you have an utterly massive build of upwards of 16 million barrels between crude and finished products. The market predictably tanked by more than a full dollar on those data within minutes, but that only lasted about 10 minutes before the market fully retraced to the upside and then rallied much higher than before the theoretically bearish data came out. Now that one is actually reasonably easy to understand. CPI and FOMC news got the rally started, and the news of China seemingly abandoning much of its zero-COVID policy added fuel to the bullish fire, to the point that the market is basically ignoring inventory data completely and marching higher despite what should have been a very bearish news event. But the part that I'm really confused about is the market shrugging off the biggest spill in the history of the Keystone Pipeline, which hit the news wires just minutes after we recorded last week's podcast on Thursday morning, December 8th. The Keystone Pipeline is the primary delivery mechanism that brings imported Canadian oil into the U.S. distribution system, and most of the oil coming out of Canada flows to Cushing, Oklahoma, the settlement location for the WTI crude oil futures contract. Past Keystone spills have resulted in panic buying, giant rises in the flat price, and blowouts in the front-of-curve WTI time spreads. When the news hit the tape last week, WTI was up nearly $3 within minutes, just as one would expect after such a big and important event. But within a couple of hours after the news came out, the market peaked, reversed, and fully retraced to the downside, and then went on to crash to an even lower low, just a hair over $70. Now, that kind of tape action would be consistent with the market realizing after those first couple of hours that maybe this spill wasn't that big of a deal, just a little spill, not as big as the earlier ones, which kept the pipeline shut down for 2 weeks or more. But this one was actually much worse. It's a major spill. The cleanup alone is expected to take at least 5 weeks, and there's still no target date for reopening the affected section of the pipeline. But even more interesting than flat price, past Keystone spills have caused the prompt WTI time spread to blow out to $3 or more of backwardation, as fears mount that there won't be enough oil in Cushing to settle the next futures contract. Keystone carries up to 590,000 barrels a day from Canada to Cushing, and it just went offline. And the time spreads barely even moved and stayed in contango. And all of this happened when we started at lower levels of Cushing inventory and therefore greater vulnerability to loss of supply than the last spread a couple of years ago that blew time spreads out to wider than $3. Just yesterday, Wednesday, TC Energy announced the restart of the unaffected portion, which will allow Canadian oil to flow to Pacoda, Illinois. But that news came out after all of the market action that I've described so far, and as of now, there's not even an estimate for how long it will take to resume service to Cushing, Oklahoma, where WTI is settled. Taken together, the first conclusion is clear. For some reason, the market just plain isn't concerned about supply or inventory. The market moving to new cycle lows in the immediate aftermath of Keystone taking 500,000 barrels per day of Canadian import oil offline completely, and then yesterday's gigantic inventory builds having virtually no effect in slowing down the rally that was already in progress, clearly teaches us that when the market is moving in either direction, up or down, inventory data or news posing dire threats to inventory levels are being completely ignored by this market. The bigger question is why the market suddenly doesn't seem to care at all about gigantic inventory-related news, both bullish and bearish, at a time when inventories are critically low. And that's where I'm at a complete loss to explain this. The next few days will be very important. The China reopening news that so many analysts, including myself and Goldman Sachs, predicted would turn this market around seems to be happening right now, as Jim Bianco will explain in more detail in the feature interview. That alone should cause time spreads to flip back into backwardation, but so far they haven't. Meanwhile, the Keystone outage should have flipped them back last week, but it didn't. The flat price has rallied up to the 21-day moving average, but it still has a long way to go to the upside before a trend reversal could be declared. In many ways, the bullish fundamentals to carry the market higher are now in place. China moving toward reopening, Keystone offline for an unspecified time, and so forth. Yet, as I'm recording this, the January to February time spread is still in contango to the tune of 7 cents. A sign that the market probably hasn't put in its final bottom yet. Bottom line, The signals are conflicting and don't make sense to me, so I'm on the sidelines. Prompt spreads in contango with Cushing at generational low inventory, just above operational minimums, and Keystone offline for an uncertain amount of time, threatening those levels further, just plain doesn't make sense to me.
Well, this week's feature interview guest is Bianco research founder Jim Bianco. Eric, why did we invite Jim back on the show this week?
Well, Patrick, it's an FOMC week, and Jim is a macro heavy with a fixed income focus. He's also the guy who called the pandemic based on China case data before anybody else did. And there's new news out of China to talk about on that front. So it was time to get him back. We just had him 3 months ago, but we've got so much that's right up his alley that we thought it would be good to put him on as our last regular format show guest for the year.
Well, Eric's interview with Jim Bianco is coming up as MacroVoices continues right after this message from our sponsor.
If you invest to bring about a world powered by green energy, you should meet Respect Energy, a leading European trader of renewable energy that serves as a one-stop shop for green energy investors in Europe. Respect Energy brings together independent power producers, accredited and institutional investors holding assets in renewables, or undertaking investments in new green energy production, such as wind and solar photovoltaic power plants. More than 600 institutional and accredited investors have already entrusted Respect Energy with the sale of their electricity production, portfolio management, O&M services, EPC, and project development. If you want to invest in green energy in Europe with the help of a trusted partner, contact Respect Energy today and ask for a tailor-made solution. For more information, visit respect.energy.
And now, with this week's special guest, here's hedge fund manager Eric Townsend.
Joining me now is Bianco research founder Jim Bianco. Jim, it's great to get you back on the program. We have quite a bit of news this week, CPI and FOMC. Let's start with CPI. Give us the update. What was the data? What does it mean?
Data came in weaker than expected, and expected is the key word. And on a year-over-year basis, it was 7.1% is what the growth rate is, November to November. And core CPI came in at a 6% growth rate, November to November, slightly below what was expected. The market, I want to say predictably, took off on this news, but that understates the reaction that the stock market had. We can talk about this a little bit later, but we were up 3% next trade on the S&P off of CPI. We also did that a month ago off of CPI. I think those are the only two examples I could find of the market being up 3% next trade in the last couple of decades. I can find examples of it being down, but not necessarily being up like that, just to show you how focused the market is. But turning back to CPI, you could attribute most of the undershoot in expectations to two categories. Used car prices fell and gasoline prices fell. So all in all, it was a report that has everybody thinking inflation is peaked. Now, I've also argued that inflation is peaked. It actually peaked in June. And for people to say that, see, this is it, inflation is peaked, correct. But that's not as important as the next question. Is it on its way back to 2% or is it on its way back to 4%? Because either one of those is going to produce a vastly different response out of the FOMC and out of the market. 4%, the Fed's only at neutral. The hike that they did, we're recording the day of the FOMC, which we'll talk about in a second. The hike only got them back to neutral if we're going back to 4% CPI. If we go back to 2% CPI, then they are above in tightening category, and they might have some room later this year to ease. I happen to be in the camp that inflation is probably going to stop closer to 4% than it is to 2%. So yes, it's peaked. Yes, that's been obvious even before the CPI report this week. But again, it's really all about how far down is it going to go, not is it going down.
It seems to me that I think of waves on the ocean. There's little waves on top of big waves. And it seems to me there's two components here, Jim. There is a transitory inflation effect that has everything to do with the pandemic. And everybody seems to agree that that's an effect that is pandemic driven. There may or may not also be a larger wave underneath that surface wave, which would be a new secular inflation trend. And it seems like not too many people agree with me that there probably is an underlying bigger wave. It sounds like from what you're saying, I guess what I'd like to clarify is when you say we're headed back to 4%, does that mean you think this is transitory effects of the pandemic, but it's just not done yet? Or is it because you see what I see, which is maybe there's a bigger wave, the small wave, which is transitory effects, is peaked, but that small wave is still sitting on top of a bigger wave, which maybe hasn't peaked yet?
No, I think you put it well. And, I'm going to restate a little bit of what you said. Yes. First of all, inflation was in June at 9%, and it's fallen to 7.1. It better have peaked, because if you're going to tell me, no, the inflation rate's going to be between 7 and 9 for the next year and a half, stocks might be as much as 50% too high. And we'll rerun 2008, if not worse, if that's where they're going to stay. Now, I don't think they're going to stay. They're going to come back down. So why did it get to 9% and why is it deflating? You're right. There was some stresses with reopening of the economy, supply chain constraints, excess savings, which was pushing demand because of all the fiscal stimulus in 20 and 21. They got you to 9%. That's coming out of the system. But when you settle it out, I do think that structurally in the post-pandemic era, we're going to probably settle out at a higher level than we did before. The old level was 2. I think the higher level is going to be closer to 4. Yeah, maybe it's 3.5 or so. But my main takeaway is significantly above 2. Why? Secular forces that have taken place post-pandemic. I've referred to them as the end of cheap labor, cheap goods, and cheap energy. Cheap labor, we still got sub 4% inflation. We've still got wage growth. We've still got labor hoarding by companies. It's hard to find workers. A statistic Jay Powell likes to cite is there's 6 million unemployed people. There's 10 million open jobs in the United States. That's a 1.7 times open jobs to unemployed. We've never seen it this high before. So, the worker is in the driver's seat. The worker can make demands like, I want to work from home a couple of days a week. I want a bigger raise. And if you don't give it to me, I'll quit and I'll go find another job that gives it to me. So end of cheap labor, end of cheap goods. Look, I think we're at peak globalization. The week we're recording, the Biden administration has already come out and sanctioned another 30 Chinese companies, tech companies, because of the ongoing tensions with them. We'll talk about zero COVID and all of the problems there. But the idea that offshoring your production is going to produce cheap goods, I think is in the rearview mirror as well. And cheap energy, that's all about Russia. Russia's the biggest energy producer. Saudi Arabia might be the biggest crude oil producer, but when you add in natural gas and everything else, I think Russia's the biggest energy producer. They've shut down Nord Stream. There's a lot of stress with Russia. They're not going to become a cheap energy producer again anytime soon. Again, the week we're recording, the Biden administration is thinking about sending Patriot missile batteries to the Ukraine, and Russia has already announced, well, if they're going to do that, we're going to have to take them out. Doesn't sound like we're anywhere close to, having a kumbaya moment with Putin and reopening up the natural gas spigots to Europe. So the cheap energy era is over. Yes, these can be replaced. We can find a new source of cheap energy, a different source of cheap labor, or some other globalization 2.0. But that will require a lot of infrastructure spending, as in trillions of dollars, and many, many years to restructure a global economy for that type of environment. And that means along the way, higher frictions, higher inflation, higher costs.
CPI was Tuesday's news, Wednesday afternoon, just a couple of hours before we're recording, now late on Wednesday afternoon. The FOMC met. They raised their benchmark Fed funds rate by another 50 basis points. Now, the last time they raised it this high was 2007. Nothing bad happened after that, Jim. So what does this mean?
It's interesting because there seems to be two narratives out there. There's the Fed's narrative and the market's narrative. The Fed's narrative, and to be clear for most people, if you were to put the Fed in one of those hawk dove meters, who's the most dovish person, who's the most hawkish person, I would say to you that the most dovish person might be Vice Chairman Lael Brainerd. And the most hawkish person might be Chairman Jay Powell. Now, this is unusual because usually the vice chairman and the chairman are somewhere in the middle, but they kind of occupy the extremes. And there's a lot of tension at the Fed. Wall Street Journal, Nick Timmeros wrote about it this week, that there's not a lot of disagreement within that room about what policy should be. And I point that out to remind everybody, the Fed's a benevolent dictator. The Fed chairman gets what the Fed chairman wants. And the Fed chairman is hawkish. And he wants more rate hikes. He wants to stick at the terminal rate a lot longer than people think. He wants to make sure that inflation is unmistakably going back to 2% before he even thinks about cutting rates. That's what the chairman wants. That's what the Fed is saying. The market seems to be saying, Jay, I hear you. Jay, I understand. But Jay, you're going to change your mind in the next 3 to 6 months. You're going to see data that says we're in a recession or close to recession. You're going to see data that says, just like the last 2 CPI numbers, it's falling a lot faster than you think. So Jay, you may say that now in mid-December, but wait till the spring, Jay. You're going to see data that's going to make you think like us. It's time to start cutting rates. It's time to start ending this rate campaign. And it's time for the markets to embrace and celebrate that we have cheap money returning.
Jim, let's talk a little bit more about the terminal rate, where they eventually stop hiking rates. As you just described, it's really not, I think, just Jay Powell, because if you look at the dot plot, all of the participants seem to, I don't know about Lael Brainerd, but most of the participants in the FOMC seem to think that the terminal rate is going to be higher and farther out than the market thinks. And the market's not buying the story. So who do you think is going to be right? Is the market being complacent, or is the Fed being unrealistic? If you had to bet on who wins that tug of war that you just described, where the market doesn't believe the Fed, do you think that Jay Powell is going to stick to his guns and say, no, I meant what I said? We're really going to keep on raising until we get to 2% inflation? Or do you think the market will be proven right and that Jay Powell's bluff will be called, so to speak, and he'll have to reverse course?
Well, let's put some parameters on it, because I don't think that the market and Jay are quite as far apart. Yes, the terminal rate, for those that are not familiar with the term, that means the highest rate where the Fed stops raising rates. The market expects that rate to be somewhere between 4.75 and 5% around June. That's where the market is. The Fed had as its year-end target for the funds rate, because they put out a dot plot, where do you think the funds rate's going to be in 2023? Of 5.1. So that means 5 to 5.25 as opposed to 4.75 to 5. So there's a difference in the market there between of 25 basis points. Of course, the dot plot is where do you think we're going to be at the end of the year? So the Fed is saying we're going to be at 5.10 at the end of the year. But in 2024, the Fed dot plot has it at 4.1. So they will be cutting rates in 24 by 100 basis point. So where the market is Jay, you're going to go to 5-ish. Maybe it's 4.75, 5, maybe it's 5.25, but let's call it 5-ish. And then the market thinks before the end of this year, you'll be cutting rates. The Fed is saying with their dots, no, those rate cuts will come next year, or next year being 2024. And so really there's just a quibble about timing here, but the broad contours are correct. Now, who's going to be correct? I'll point out to you that largely this year, the Fed has been a giant bully. It has been raising rates by 50, by 75, by 75, by 75, by 50 again. And all year, the market has been saying, Fed's got to stop, Fed's got to pivot, Fed's got to pause. These are the words that we've been using. And the Fed hasn't. Now, the big reason the Fed hasn't, 2 reasons. One, inflation has stayed up. It's still 7%. It's still unacceptably high, even though it's coming down. And 2, there has not been any serious signs of a recession yet, other than housing. And housing is very interest sensitive. You haven't seen any real weakness In labor, we still produce well over 200,000, 250,000 jobs a month, according to the payroll report. We still have well under 4% on the unemployment rate. Initial claims are down as well, too. So there's very little signs that the economy has produced a recession. Now, what would get the Fed to buckle would probably be if you were to see zero job growth, negative job growth, serious signs outside of housing that you have a recession. If you did that, then you could apply, the Lael Brainards could apply pressure to the Fed or to the chairman and say, Jay, you can't keep throwing people out of work. To date, that hasn't been happening. So I'm going to come down on the side for early, that the chairman's going to get what the chairman wants. Only if the data really turns south soon. And I want to be clear on that, south soon. Do I think that the data is going to weaken for the economy? Yes. Do I think that there's a probability that we're going to have a recession? Sure, even though it's probably the most discounted recession in history. But where I might differ from the crowd is it might be a third or fourth quarter or first quarter of 24 story that serious slowdown shows up several months away. Wall Street wants the slowdown by the second week of January so they could keep talking about a pivot, so they could continue to engineer a stock rally based on the idea that we're going to have cheap money. So Wall Street's impatience might not be rewarded. And that's why I think the chairman's going to get what the chairman wants, and he's going to stay hawkish for longer.
Let's talk about Treasury yields a little bit farther out on the curve, because I agree with you, Jim. I think that, we're headed down in inflation, but nowhere close to 2%. I think at least 4%. Well, hang on a second, Jim. If I look at the 10-year yield, it's back down below 3.5% now. So clearly the market doesn't think that inflation is going to last for 10 years. I think it is. What do you make of the longer-term yields and how the back of the curve looks? What message is that giving us?
Well, let's start with longer-term yields. You're right. They've come down from about 440 to about 350. 440 was set, in early November. So in the last 5 weeks or so, they're down almost a full percentage point. I would also throw out, just to describe what's happening in the market, short-term interest rates, the funds rate, the 2-year rate, are up, and the curve is the most inverted. In other words, the 2-year yield is about 80 basis points above the 10-year. You have to go back to 1981 to find the curve that inverted. So what's the message from the market? Recession. The message from the market is the Fed is going to be too slow at recognizing the signs of recession. That's why short rates are up. Long rates are down because we are going to see a recession sooner rather than later. That's what the inverted curve signaling is. That, like I said, that could be correct. An inverted curve, but the timing might be a little bit longer than people think. An inverted curve leads a recession on average by about 10 months, can be as much as 18 months. It's not 3 or 4 or 5 months. The curve consistently inverted, and I'm talking about the 10-year 3-month curve, because that's the one all the research has been done on, only in the last month. So that would put you at a standard recession in the fourth quarter, not in February. And that's really what the market, again, it comes back to this idea that the market is impatient. It wants to see signs of a slowdown. That's where I think you're seeing with the 10-year and with the inversion of the curve. Now, technically, if you backed up your charts and looked at the charts all the way back to January, has the market broken down from its major uptrend? I don't think it has. I'm not so sure 440 was the high yield for the cycle that was set in early November. If you go back and you look at June to August, we saw an even bigger drop of about 150 basis points on yields before they turned around and they made a new high. So I wouldn't be surprised if this is just a standard correction within a larger uptrend. And by the first half of the year, say spring, summer, we're back towards that 4.5%, if not slightly higher on the funds rate. One other thing about that too, let's assume that the Fed follows through, raises rates to somewhere at around 5%, 5 to 5.25, 4.75 to 5. The 2-year note yield, I'm going to diverge this for a second to the short end. The 2-year note yield was started trading in 1976. Every rate hike cycle, the high in the 2-year yield is above the eventual terminal rate. Now, the 2-year yield hit 471. If we're going to go to 475 to 5 or 5 to 5.25, this would be the first rate hike cycle that the 2-year yield ended below the terminal rate. So I do think that the 2-year yield's high is still ahead of us as well. That could be off near 5.5. I don't think the yield curve is going to go minus 150 basis points. If it stays at minus 100, I'm talking about a scenario here where we're looking at 550 on the 2-year note, 450 on the 10-year note, somewhere in the spring or summer. I know I'm giving specific targets, and I always know when I give specific targets, that's usually what doesn't happen. But conceptually is what I want people to think about what I'm saying, not literally, so that both rates are going to go higher, and we're not done, especially if the terminal rate is still ahead of us and it's much higher than we've seen so far.
Jim, something I find interesting is lots and lots of people in the marketplace are talking about what you and I are talking about right now, which is higher rates of interest on government debt, mortgages, and so forth. And there's been a lot of analysis of, what's going to happen. Can the U.S. government tolerate higher treasury yields because they've got to refinance their debt and so forth? What I don't see discussed anywhere really is an analysis of the high yield debt, the companies that have to finance at fairly high interest rates. They, in many cases, similar to the federal government, have shorter duration debt that risks having to be refinanced at much higher rates as they roll that debt over. And it seems to me like there's potentially a domino effect there where if they can't afford to roll their debt forward, those companies are at risk. You get downgrade risks of companies that are above junk getting downgraded to junk. Is there a story there? Is there an investment play there? How should I think about the high yield market?
Yeah, there's two stories there. The first one is the moral hazard story. And in the moral hazard story, most people are more familiar with this story in the equity market. And that is basically, I can't believe the Fed's raising rates so much. I can't believe the Fed is hostile to the stock market. I like to joke, Eric, that the investment strategy from 2010 to 2021 was you bought the S&P 500 index fund, and then you whine to the Fed, Jay, you got to do more work to get the stock market up because I'm not making enough money to buy a new Tesla here. So come on, keep going, Jay. Cut rates, do more QE because my spiders aren't rallying enough. That was the moral hazard. Well, the moral hazard in the bond market, especially in the high yield market, was born out of 2020. In 2020, when the Fed stepped in with its emergency programs, it started purchasing high yield debt and high yield ETFs. Bob Michael, who's the chief fixed income strategist at JP Morgan, summed it up best. I'm buying high yield, he said, in the spring, early summer of 2020. What are you, crazy, Bob? These spreads are wide. We're going into a terrible recession. And his answer was very simple. I'm co-investing with the Fed. If the guy with the printing press is going to make sure that those yields are not going to go back wider, I'm not going to fight him. And he was right. That lingers in the high yield market today, I believe. So when people ask, why are spreads so tight in the high yield market? Because at the end of the day, if things get ugly, the Fed has already set the precedent in 2020. They will print money and they will make sure that those spreads stop widening. Why? Because they did 2 years ago. And so that's why I think spreads are so much tighter than it is now. And it's enabling a lot of zombie companies to stay zombie companies. Instead of dying off because they can't get financing, they're still existing. Now, I've said that it's not as easy as it was a year ago, but it's not as difficult as it could be. And if I'm correct in what I said earlier, that the downturn in the economy, while I agree with the consensus, it may happen, but it's way off there. Later this year in the 24, you could see high yield run into trouble at that point, especially if the market starts realizing, and this is a possibility, look, we got a downturn, but we also have inflation. Tough on the downturn here. We got to do something about inflation. And then he's not going to turn around and be your co-investor in the high yield market. So to one extent, if the question is why are spreads so tight relative to everything we've seen, It is the moral hazard that we saw from 2020 right now, but we haven't seen the downturn yet. And if that really comes in the second half of the year, then I think we could see high yield run into trouble. One last thing about high yield. If all of the major capital markets, it is the most subject to boom and bust. High yield only knows one thing: overdo it. It overdoes it on the tightening. It overdoes it on the widening. It swings too wildly from one extreme to another extreme. So maybe it's at one extreme now, and that will be offset by a future extreme in the other direction.
Jim, I wanted to start with fixed income because that's your specialty, but I'm sure a lot of our listeners want to know, okay, what does all of this talk mean for the stock market?
That's going to be interesting to answer because I'm going to answer it this way. The stock market, if you look at forward PE ratios, and that is what is the estimate on Wall Street of 12-month earnings divided by the price, it's 18.5 on the S&P. If you look at it for 2 years out or 3 years out, yes, Wall Street does have estimates of those, it's 15 and 17. These are not cheap numbers. This is not a cheap market by any stretch of the imagination. Now, it might not be the upper 20s, which we saw in late 2020 and in 2000, but it's certainly not 10 or 11 on the forward PEs like we've seen at the bottom of previous recessions. And so what people have to understand is, what is the justification for buying 18 multiples on the stock market ahead of a perceived recession? And the answer is they're discounting an interest rate. They're discounting a 3.5% to 4% funds rate in 2024. The market, people talk about the market pricing in 5% on the terminal rate. I'd actually argue it isn't. What it's pricing is, yeah, Jay's going to go to the terminal rate because he has to, because he said so, but then he's going to turn around and he's going to start cutting rates at the first sign of weakness, and eventually we'll get back to 4 to 3, 3.5 by early 24. The Fed's already told us they think they're going to be at 4.1 in 24. So we're just arguing a little bit about timing here, not about direction. And so let's price in 3.5 to 4 on the stock market. That's why I think you see such lofty valuations, lofty relative to ahead of a recession. We're buying 18 PEs, and a recession that's being largely discounted, we're paying 15 PE for 3-year out earnings, which, by the way, can be wildly off on those estimates anyway. Usually they're way too high. And so I think the answer is because we're anticipating the Fed's going to come off and lower rates. I've argued that the stock market is a liquidity junkie. It wants, first and foremost, cheap money, and it wants an abundance of cheap money. And we're in a perverse situation in the stock market. As I pointed out, a recession is the most discounted it's been in 50 years, according to the Philadelphia Fed survey. Unemployment rates are expected to rise dramatically in 2023. Bloomberg has surveyed stock strategists on Wall Street since 1999 for 24 years. This is the first year the average stock strategist on Wall Street has a decline in the stock market. They didn't in 2000. They didn't in the weeks after 9/11 in 2001. They didn't in 2008. They didn't in 2009. They didn't even project a decline in the stock market for 2021 after COVID. They are now. Why all this gloom and doom? You usually get fired on Wall Street for being this gloomy and doomy, because that's the bull story. The bull story is you're going to pick companies that have good earnings, good management, good products, and then you're going to hope they get blown completely to hell. They have terrible earnings. They have to fire people. They have to cut back, because then the Fed's going to pivot and your stock's going to go to the moon. God forbid you buy good companies and those good companies produce earnings and have to hire people. And oh man, if they have to have such demand, they got to raise prices. Katie barred the door on what's going to happen to the stock market in 2023. Now, obviously, I'm saying this sarcastically to get my point across. This is the upside down world we're in right now when it comes to the stock market. We need things to go bad to get a good return. If things go good, we're going to get a bad return. And this is how you break markets after 15 years of QE, because people, like I said before, the strategy that's worked is buy spiders and whine that the Fed's not doing enough to make me afford a Tesla, is that, we need cheap money. And if we have to wreck the economy to get cheap money, that's the bull story. So hopefully people understand that this is not like something we've seen before. And this is where I think the stock market is. Why are we paying such lofty valuations for the market? Because we're anticipating lower rates in the future. If we don't get those lower rates because a recession doesn't materialize or doesn't materialize faster, we could actually see the market struggle. Now, wait, like I said, you mean if things go well, the market goes down, and if things go poorly, the market goes up? Yes, that's been the case of how it's traded all year. Every time we get bad data, good news is bad news, or bad news is good news. That's the way it's been trading, and I think that will continue to be that way.
Jim, these two big data events this week, the CPI on Tuesday and then the FOMC press release and press briefing on Wednesday, have been widely anticipated in markets to the point that on Wall Street, all eyes for the last 48 hours have been focused exactly and completely on those two events. Except for your eyes, you've actually been looking at some things going on in China in the last 48 hours. What's happening there?
So China's been under zero COVID. And what happened was they started to get some real pushback from the population about zero COVID. It began at the iPhone factory at Foxconn, where they had some protests. And I might add that 40 people were injured in protests on the factory floor. And as far as my knowledge goes, Tim Cook hasn't said anything about that, where they make the iPhones. And then it led to there was a fire. Now, let me paint a quick visual for people. Most people in China live in apartments, and most of these apartments, they don't have these grand foyers with marble, entrances and velvet couches in them and stuff. Their front door is usually a steel door that looks like the side door where you throw out the trash in a Western apartment. If anybody in that apartment tests positive, that steel door is literally welded shut and everybody is stuck in that apartment. And the government promises that they'll send you food and medicine, and usually they don't. And if they don't, you're on a diet. Tough. There was a fire in one of those apartments, and the people were caught in the apartment building were literally banging on the front door to get out, and they couldn't because the door was welded shut because of zero COVID, and about 10 to 12 people died in the fire, and that sparked a big protest. But the protest wasn't just, please end zero COVID. The protest was that the protesters held up white blank pieces of paper called the White Paper Revolution. And they were basically protesting about censorship by the government. By holding up a white piece of paper, we're not allowed to say anything, and that tells you what you need to know. So these people are not protesting that, please, Mr. Xi, please end zero COVID so I could go back to working at the iPhone factory for 14 hours a day, and maybe you could give me an extra cup of rice if I promise to be a good little worker. No, they want a democratic change. Well, the government heard that, and the government reversed the zero COVID policies, I think in the short term, in order to call off the revolution that seemed to be brewing. For the moment, it seems to have calmed people down. But they've almost gone too far in the other direction. The day we're recording, December 14th, they announced that zero COVID's done. There's going to be no more reporting about COVID out of China. They used to give daily reporting. Number of people died, how many people have positive tests, how many are asymptomatic versus symptomatic. No, we don't need to do any of that anymore because zero COVID is over. But at the same time, anecdotal evidence is very strong that they don't have herd immunity in China. They're not close to herd immunity in China because they've been locked down for 3 years. And COVID is ripping through the population. The hospitals are overrun. People are getting sick. There was a story Tuesday, the day before we're recording, that trading in the yuan, their currency, was the lowest since April. And the reason cited was so many currency traders were out sick that absenteeism is nearly 50% at the dealing houses, that's why volume is down in the currency market, that there physically isn't enough people there to do the trading that they need to do. This is going to create all kind of havoc in China. For 3 years, they were told by the propaganda in China, this is the Black Death. We need to lock you and weld you in your apartment because it's that dangerous. And now they're all of a sudden going to say, after 3 years of this, it's just the flu. Come on out and enjoy yourself. And you could go back. Well, if you're going to unweld the front door, am I going to walk out the front door? Sure. Am I going to go back to mass gatherings of people and think about one mass gathering of people is work? Am I going to go back to work as quickly because it is ripping through the population right now? And maybe they'll get to herd immunity in 6 months or 9 months, but it's going to be chaotic and it's going to be messy. Now, I'll give people one metric they can look at. This is available online. It is available on a Bloomberg. China still reports daily usage of their subway systems in Beijing, Shanghai, and the like, the China metro usage. Normally in Beijing, the subway in China will get about 8 to 10 million riders a day, about the size of New York City in terms of the ridership. They're down at around 1.5 to 2. And in the last week or so, as they've been lifting COVID restrictions, it hasn't really been rising that much at all. Now, maybe I'm early, check back in 2 or 3 weeks, but I think that's going to tell the tale of the tape is after 3 years of telling people that this is the Black Death, are we just going to say, okay, now it's Tuesday and now it's just the flu, you can leave? And, okay, fine. Now it's just the flu. I'll just go back and continue my life. And we'll have to see whether or not they do. But either way, this reopening of the economy is going to be chaotic. It's going to be messy. It's going to be unpredictable. And let's remember that the protesters were not asking for the end of zero COVID. They were asking for democracy change. And such a messy, chaotic opening could foster more people saying, this kind of way that the government is running things is not right. And maybe we need a change. And so I don't think the last chapter of this book about zero COVID and lifting zero COVID and reopening has been written. I know Wall Street wants to think that's it. Everybody's going to shut up. They're going to get their free extra rice and they're going to go back and make iPhones and make all kind of other stuff. And they're going to ship us stuff in abundance. And that's going to end inflation here. So Jay could cut rates and the stock market could go to 5,000. I know that's the story Wall Street wants. I'm just not so sure it's going to get it.
Jim, tell me a little bit more about what was announced today, because on one hand, it seems like the white paper revolution was all about the Chinese people demanding more transparency, more honesty from the government. But I think part of what they announced is that they're going to stop reporting the number of COVID cases. So we don't know how many people are getting sick. Is that right? And it seems like that's just going to infuriate the people, if I'm understanding the reason they were protesting correctly.
No, you're absolutely right. The white paper revolution was we want more transparency, we want more accountability. Now the government is saying, okay, you're going to get less of it. You're going to get less of it, but we're not going to weld your doors shut and you can go out and you're going to be happy. So there's a disconnect here between what the government is offering and what the people want. Now, one of the reasons that there might be this disconnect, this is an old story. We know this story over time. Xi was elected for his third term. Effectively, he's going to be leading China for life. What he has also done, if you remember the National Party Congress in late October, it's like a movie, like right out of The Sopranos, where Xi Jinping was basically escorted out of the room at the same time, is he's purged everybody that would be a dissenter. So Xi is basically like every other strongman who's elected for life, or not even elected, appointed themselves for life. He is surrounded by yes men that tell him everything he does is brilliant and he's wonderful. And boy, if we are so lucky we have somebody like you leading us. This is how they make mistakes. They constantly misjudge. He has constantly misjudged between the property crisis, between a lot of the crackdowns on whether it's gaming, how many minutes a day you could do video games, or speculators, or anything in between, including zero COVID. He has constantly misjudged on his economy. And it seems like what he's doing now with let's just abolish the transparency on COVID is going to inflame them, especially when they see that their grandparents and their parents and their sick aunts and uncles are basically in overrun hospitals that cannot get proper medical attention because COVID is ripping through a country that never achieved herd immunity like most of us have in the West, is only going to further infuriate, I think, a public that's willing to stand up to them in the first place. You got to recognize what a risk and what level of frustration the Chinese people have to come up to stand there and hold sheets of white paper to protest the government. Do not confuse them with the West. That is taking your life in your own hands when you protest that government. And they've been so fed up with it that that's what they're doing. And if the government's answer is, okay, you can leave, but we're not going to tell anybody anything, you're right. I think in the long term, that's not going to help things and probably make it worse.
Let's talk about the inflation consequences of China reopening, because one argument that I've read is, hey, China reopening, I mean, it's more demand. The economy is coming back. Chinese demand for stuff is going to exacerbate the inflation problem. The other side of it is, well, wait a minute, the source of cheap goods in the world has been China, and it's been the fact that China's offline that things have cost more. So China reopening is actually going to help inflation come down. Which is it, Jim?
Well, first of all, let's remember now that China is in the process of trying to reopen, and it's going to be chaotic and it's going to be messy for the next several months. So there's no immediate reopening right now. And like I said, I'll watch the Metro ridership data and some other things to get an idea of if people are going to be afraid to leave the house to some degree. It's going to take longer than Wall Street anticipates. But let me take your question. They are going to eventually reopen. It, I think, means two things. I think on the raw material side, China's the factory of the world. China is, by most estimates, I think, Eric, correct me if you've heard something different, something like 2 million barrels a day of oil less demanded from China because of various zero COVID policies. Remember, it's a country of 1.4 billion people that have been restricted to staying in their homes, so they're consuming less energy. And so what you'll see in a reopening is things like crude oil, things like copper, raw materials, they're going to rise. JP Morgan has now got its average crude oil price. $80 is crude oil now. They think that for all of 2023, it's going to average $100 because of what it means for the reopening. On the good side, finished goods, the argument you're going to see there is that there's the supply chain right now is a mess in China. 1/3 of all containers, those 40-foot box containers that are exported to the United States come from China. And the problem with China is even though maybe 20 to 25% of the country is in some form of restriction or lockdown, that in a just-in-time zero inventory world, I rely on somebody to produce something for somebody else that I need. And if somewhere along the line, one of those pieces in the chain is in lockdown, the whole chain stops. So even if just 20% of the country's locked down, effectively 100% of the country's disrupted because of it. And so once you get past that and you get the supply chain operating properly again, you could see a ramping up of goods. Wall Street, I think, misjudges a statistic. They look at the shipping rates out of China. What does it cost to send a 40-foot container box from China to the United States? The beginning of the year, it was about $15,000 a box, roughly. Today, it's roughly about $2,000 a box at the pre-pandemic levels. Oh, that's it. Inflation has been canceled, is what you hear from people. No, what that is a sign of is how chaotic and unreliable manufacturing is. They can't produce stuff. And the World Trade Organization does actually do a trade production measure that is showing that production out of China is down and down a lot because of these chaotic processes that zero COVID and other things have fostered on their economy. And so the reason that shipping rates are down is that these big ships that take containers are not just going to float off the coast of China waiting for something. They're going to cut their rates to get a cargo now. And so it's a sign of that weakness. If China is going to ramp up to get production going by, say, the second half of the year, we back up to what we were talking about a few minutes ago. That could be right at the moment that the U.S. is experiencing a slowdown. And all of a sudden, we're ready to go. We're ready to start making stuff just like it's 2019. And then their U.S. suppliers are going to say, we don't need it because we got a slowdown right now. So they're going to perpetually stay out of sync with the rest of the world. They have been since COVID. It has shown up in their economic statistics. Their GDP numbers have been some of the worst since they started reporting GDP in the late 70s. And I just don't see it getting better right now.
Jim, let's move on to the gold market. You know, as a gold investor, it's easy to pat myself on the back and say, boy, the returns have been fantastic for the last couple of months. But frankly, I can't put my finger on what the real driver is, because something changed dramatically on November 4th when we saw just a huge move up in gold prices in the beginning of a monstrous $200 plus rally now. That data came out before the November CPI print, so you can't attribute it to CPI unless you think somebody had the number at least a week ahead of time, or several days ahead of time. The CPI helped it, and that really seemed to take things higher. But we had another miss just yesterday on CPI, and it came in below expectations, and gold was up, but nothing close to what it was last month. So some people have said, no, it wasn't about that, it was about central bank buying, and it makes sense to me. China has reported for the first time in years an increase in their central bank gold holdings. But hang on, that story I think really would have been ignited by the seizure of Russian FX assets. That was more than 6 months ago. You know, why would it suddenly happen November 4th? I feel like I don't really understand what's driving this rally, and that scares me because it means I don't know when it's going to end.
Well, a couple of things. November 3rd was also the high yield in the bond market. So everything kind of turned at the same time. And around November 8th, just a couple of days after that, was when the dollar started to turn down. So you had gold turn up, the dollar turn down, and yields peak, all within a week of each other. I know I said this when I last talked to you, is that the biggest problem with gold is, well, first of all, what role do we understand gold that is supposed to traditionally play? When you are worried about the health and the stability of the financial system, whether it's inflation or financial crisis or something along those lines, how do you get your money out of the financial system? Well, you really can't, but the closest you can do is gold. Now, that still sort of applies, but it only applies if you are willing to buy a sack of gold coins and bury them in the backyard, or own warehouse receipts in a foreign country outside the reach of your taxman and your governmental authority. Yeah, that's hard to do. No one knows how to do it. So we financialize gold. Oh, no, look, you could buy options. You could buy futures. You can buy ETFs. We've turned gold into another fiat currency. I know Peter Schiff doesn't want to hear it, but we've turned gold into effectively another fiat, and it trades like another fiat. So when the dollar was rallying, it was suffering like all the other fiats were suffering, and interest rates were going up. Now that rates are going down and the dollar has turned and the dollar has been weakening, I think that gold has been rallying like all the other fiats have been rallying. Now, is gold something different than the fiats? Yes. But so many people, I can't tell you how many people I've met. Oh, I own gold just in case. And I was like, well, okay, how do you own gold just in case? Well, I own some GLD. And I was like, I got news for you. If that just in case happens, your GLD is a worthless piece of paper. It is not actual gold. And now another story has been hitting lately, and that is that China desperately wants the end of the dollar as the reserve currency. Yeah, I get it. They do. But, there's no alternative. TINA, that is the ultimate TINA. There is no alternative. Maybe someday there will be, but there isn't now. And they floated the idea of using gold or yuan gold to basically pay for trade. Then we're going to have to acquire gold for trade. Now, that's a story. But, in a market full of degen short-term traders, that's enough to just get them excited as well. And we've seen a little bit of a pop in gold a couple of weeks ago, right around that story. But I think the major thing is it acts more like a fiat than anything else. So when the dollar weakens and fiats rally, gold rallies. And when the dollar strengthens on the back of higher interest rates, it sells off.
Jim, based on all that, do you think that this gold rally is topping out, or does it still have a long way to run?
I would say at this point that it's probably closer to topping out than anything else, because if I'm right on the idea that while we may see a slowdown, it's going to be longer than we think. Markets are going to get disappointed. We're going to see higher interest rates. That I think is the primary driver of the currency right now. That means maybe we're going to see a low in the sell-off of the dollar, and the dollar will start to strengthen, and then gold will get a little bit weaker as we move forward from here. And I'm not suggesting, that gold is going to fall apart, but, it could pull back in the middle of its range, which is roughly about 1,600 to about 1,850. So, it could pull back $100, $125 into the middle of that range. But I'm not ready yet to think that gold is going to take off, because I, again, view it as a fiat. If it's going to go, if we got $2,500 on gold, it's going to go with the other fiats going with it. If you think we're going to have $2,500 of gold or $3,000 of gold because, and I'll use a technical term here, Eric, that everything hits the fan, then you don't want to own GLD. You don't want to own futures. You don't want to own options on it. You want to bury coins in your backyard. And again, no one does that. It's too hard. They don't know how to do it. They don't know where to buy it. They're afraid it's going to get stolen. They'd rather buy GLD. Well, as long as that mentality exists and it still stays fiat, it's going to act like a fiat.
Well, Jim, I can't thank you enough for a terrific interview. But before I let you go, please tell our listeners a little bit more about what you do at Bianco Research and how they can follow your work.
So Bianco Research is an institutional advisory business. In other words, we publish research for institutional investors, mainly in fixed income and in the macro space. Find out more about us at our website, biancoresearch.com. It is an institutional product, which means it's a little bit pricey for the average retail investor. But I do try to keep active on social media. At Bianco Research is my handle. I would say I am like a lot of other people in the financial space. I do have a lot of accounts that spoof me, that try to get you to sign up for the wrong account and then try and ask you for money. It bothers me that my name and image is being used in that way. So I like to warn people, I will never ask you for money on DM. If somebody does, it's not me. Make sure it's the one with the blue check mark and it's got the high number of followers. If it's somebody with a few hundred followers, it's somebody that's spoofing me. I can't tell you how upsetting it is when you hear that people are being taken by something like that. You can also find me on LinkedIn too at Jim Bianco.
Jim, I really appreciate your bringing that up. And for listeners, we've got the same problem. There's a MacroVoices __ account, and there's a MacroVoices with a 0 instead of an O in the macro. Be very careful that you don't get taken by fake Twitter accounts. With Twitter in reorganization right now, they're not doing a very prompt job of getting rid of the impersonator accounts, and it's really having a strong impact on everyone. Patrick Ceresna, Nick Galarnik, and I will be back as MacroVoices continues right here at macrovoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, was great to have Jim back on the show. Now, joining us again in the post-game segment is Nick Galarnik. Now, Eric, what did you take away from the interview with Jim?
I agree with Jim that the pandemic-related transitory inflation effects have peaked and will continue to decline. But I agree even more enthusiastically with Jim's more important view, or at least I think it's more important, which is that there is a new secular inflation underlying this decline in transitory inflation effects. And I don't think we're going back to 2% inflation anytime soon, maybe not ever. So the question on my mind is, how much farther does inflation go down before it surprises most people by leveling off and then perhaps resuming a slow, steady climb to the upside? The market has not priced in that eventuality. Now, of course, inflation is not the kind of thing that tends to grow rapidly in a recession. We're about to have a recession, so maybe it doesn't really start to grow in a meaningful way until we get out of the recession. But I don't think it's going back down to 2% even in recession.
Listeners, you'll find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you're not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Jim Bianco's picture that says looking for the downloads. All right, let's talk some charts. Nick, great to have you back here, buddy. So listen, on page 2, we have that S&P 500 and obviously some significant whipsaw the last few days. Not a huge trend, but definitely some whipsaw. But now in this post-FOMC period, what levels are you looking at going into next week?
I'm looking at the 4,100 as resistance. We tested that twice in the last couple months. And then on the downside right now, 3,900 is my support area. If we break that, I do expect a gap fill at around 37.50 from a couple months back as well. Volatility is picking up a bit, so we should see some whipsaw action yesterday with FOMC. We pushed up a little bit prior, came back down after the first announcement, pushed up again, and then came back down again. So a lot of volatility yesterday. I was surprised that the PPI data coming out on Friday, when it came out higher than expected, that the market sold off initially and then closed almost flat. And then with the CPI, obviously, on Tuesday, we had a nice big gap up, and then we sold off most of that as well. So a lot of volatility, but key level I'm looking at right now is 3,900 for the support, and resistance, obviously, 4,100 or so. Eric, what are your thoughts on the S&P right here?
First of all, congratulations to Patrick for perfectly calling this last week. We got the pop up above 4,100 to, I think Patrick's words were, surprise everyone last week. And it only lasted for a few minutes in the wake of the CPI print, but it happened just about perfectly as Patrick called it. What happens next is what matters. So I'm watching closely. I don't have a strong directional view in the short term, although just looking at the tape, it seems like maybe the post-FOMC peak is in and we're headed back down to the downside. Well, we haven't seen below 100-day moving average. That was what held it last time. So if we get a close below the 100-day moving average, which is still quite a bit below the market as I'm recording, that would persuade me that perhaps the bear market is really on. At this point, I think it's a little bit too early to tell. Longer term, I'm still of the opinion that the bear market isn't over. Maybe there's going to be a Santa Claus rally through the end of the year. I don't know, but I don't think this is over. And I definitely don't think that we're headed toward a soft landing. I think we're headed into a major global recession.
Well, thanks for the shout out, Eric, in terms of the levels. But, to me, in order for this market to have in any way be bullish, it really needed something from the CPI and FOMC to kind of give a new momentum to the bulls to really start getting it to higher levels. At least these two things have now failed to be the catalysts, which us going into a quieter holiday period means that the markets are going to end up losing a lot of the momentum they built in through the month of November. And so that increases, in my mind, the vulnerability of the market going into the new year. Obviously, that 200-day moving average was one thing that we were watching, and the fact that we failed to in any sustained way hold above it, this becomes a very interesting pivot going into the new year. I'm not so sure of my confidence level that something big happens in the last few weeks of this year. But the more momentum we lose here, the increasing likelihood that January could have us taking another trip back, at least down to the previous lows. And so the hedging strategies that, Nick, we talked about are definitely going to continue to be a valuable tool to have in your toolbox. And I think we can spend some time in the new year talking further about that topic. With that said, though, on page 3, we have the NASDAQ. And what levels are you watching for this, Nick?
Yeah, Patrick. Looking at NASDAQ right now, I see on the Qs 300 as resistance. I thought we would gap fill that 310 area pretty fast after that nice little rally a couple weeks ago, but that didn't happen, obviously. And now support is heavy at 280, which we're almost at right now, 283 roughly. There's a gap to fill at 263 from a few months back as well. That one would probably be my target for the gap fill on the downside if we do break 280. And today is not looking too good overall for the bulls.
Nick, listen, buddy. What I was observing about the Nasdaq, particularly, is just how weak the price action has been relative to the S&P. And what we had was at least the S&P 500 in the last impulse was actually able to break to a higher high. Instead, what we saw the Nasdaq attempt to even break those highs that it was establishing throughout November and that going into that first few days of December. And it simply gives it right back, and it's just such active distribution. And one of the things that's going to be really important for me to see is whether or not those lows on the NASDAQ that, in this case on the Qs, around that 280, whether we give those out next week. Because that would really demonstrate to me that the NASDAQ is vulnerable for a breakdown, and that could really drag everything down, particularly if it's a number of these FANG stocks making lower lows. That's going to be the focal point. So that's certainly on my mind. But you know what, Nick, what I wanted to talk about was this VIX. And what was really interesting to me here was obviously we had the spike in vol. And that was going into the CPI and into the FOMC. And it's interesting that while the market's been weakening, the VIX is completely backed off down to the 21 handle. And what I find that interesting about that, at least from my perspective, is that now that previous high near 25 is actually going to be important, because if the market is going to go into any sustained new sell cycle, we should see sustained higher volatility, particularly north of 25. And that becomes, therefore, sort of, to me anyway, a canary in the coal mine. Will volatility start to trend higher from these levels or not? What's your thoughts on the VIX and where it's going?
Looking at the VIX, like as you said, right, that spike up to 26, I thought we'd get a continuation move to 30 or so on a further pullback. Very surprising to see it pull right back. But you got to remember that this week is quad witching, right? So Friday we have expiration for 4 different main assets, and right now support is around 20 again. So I do expect us to pick up that VIX past this Friday. And if you're looking at the VIX options as well, right now, yesterday the put to call volume was 0.02, meaning that there's roughly 50 contracts being bought per on the call side per put being bought, right? So heavy call buying on the VIX, which is obviously kind of bearish going forward. That being said, again, we expect about 1.25% moves per day on average with the VIX at these current levels. That's my thought right now on the VIX. Now, moving on to the US dollar on page 5. Eric, has anything changed in your thinking here?
Last week, I said the next major tell to watch for to confirm the dollar's downtrend would be a daily close below 104. Well, and this week, that's exactly what we got. So far, we've only traded a little bit below 104, so the possibility of a fake breakdown is still there. As I'm recording this on Thursday morning, we are back above 104, but only a little bit above it. But failing an exuberant rally well above 104, the trend is still down and looks to have farther to go.
You know, Eric, when I'm looking at that dollar, obviously it's a prevailing downtrend. The price action continues to be weak, but increasingly I'm getting into the camp where I think that the extent of the dollar damage in this pullback is mostly rearview mirror. And while certainly another dip down below 104 can happen here, I think that the next 5-point move or more in the dollar index is actually to the upside, not to the downside. And so while we haven't seen a decisive shift in trend, I'm certainly going to be entertaining the idea of watching for reversal patterns and things that might indicate that we're going to have a counter trend dollar move. And that's certainly that going to be my focal point going into next week. On page 6, though, I wanted to just quickly comment on crude oil here. I know, Eric, you had that commentary at the start of the show, but what I wanted to highlight here was we obviously had a very ugly downtrend that saw us hit that 70 handle on that January oil contract. And we finally got a bounce, a little bit of tailwind from a China reopening story. But we're getting now to some very interesting levels, around the $77, $78 level where we're trading. It's where those September lows came in. And it's going to be a really important stress moment. What we've seen with crude is every time these kind of 3-4 day rallies occur that are in the $5 to $8 range, they have always been faded. And the distribution almost immediately kicks in after these kind of bounces. And so this is a moment of truth here. Are we going to see crude oil resume this trend of lower highs and lower lows and rolling over, or will we finally see some signs that the bulls are back? And that to me would be a break of crude oil north of this $80 area and then not make lower lows. And that's certainly going to be what I'm going to be watching anyway on crude.
Let's move on to gold on page 7. Eric, what are your thoughts here?
Jim Bianco made an excellent point that the peak in Treasury yields perfectly coincides with the start of this rally. So if this is mostly about yields, I guess that means how much farther gold has to run to the upside is probably a function of how much farther yields have to run to the downside. And that remains an open question. Meanwhile, gold is down sharply overnight, trading as low as $50 in the Wednesday to Thursday overnight session, below its high that was put in just after the CPI data came out. So it's going to be interesting to see what happens next.
Eric, on gold, I've been relatively bullish for the last couple months, and I've been looking for some follow-through. And even silver has actually been behaving better. But the fact is gold's getting a little bit heavy here, and I continue to view it as a cross currency to the U.S. dollar. Jim talked about that during the interview, and it really does echo my view. So really, because generally I think that the dollar is so oversold and ready to go the other way, I have to be in the camp that that gold at minimum on the short to intermediate time frame has room to give some of those gains back. Now, overall, on the big picture, I actually remain quite bullish gold, but it just may not be the right time in the cycle for gold to start an epic new bull run. It might be later in 2023 where we see that. And so while it was a great run on the upside on gold here, I'm far more short-term neutral, and I think that's the way that I'm going to be approaching it here.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. That's a wrap for our regular show format in 2022. I hope you'll all enjoy our pre-recorded holiday special on nuclear energy, which will feature nuclear engineer Mark Nelson next week on December 22nd, and Uranium Insider newsletter editor Justin Hune on December 29th. There will be no crude oil report or postgame segment in the holiday special episodes, and we'll be back with our regular format again on January 5th. Happy holidays, everyone. See you next year. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview, as well as a link to the chart book, which is discussed in the postgame, and a link to a number of articles that we found really interesting. So you'll find this and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases, and also follow Patrick at Patrick Serezna. On behalf of Eric Townsend, Patrick Serezna, and myself, thank you for listening, and see you all next year.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.